Everyone thinks insurance protects you. They're wrong. It can actually make you reckless. The moment you sign an insurance policy, something shifts in your mind, not consciously, but the safety net you've just purchased has a hidden cost. It can change the way you behave. This phenomenon is called moral hazard, and it's one of the most consequential forces shaping how insurance works and how much it costs. Here's the core problem. When someone else bears the financial risk of your loss, you have less incentive to prevent that loss. A homeowner with fire insurance might be less diligent about checking smoke detectors. A driver with collision coverage might take more aggressive risks on the highway, not because they're malicious, but because the consequences feel distant, absorbed by the insurer. Insurance companies understood this centuries ago. Early marine insurers in the 1600 discovered that ships insured against loss were more likely to sink, not coincidence. Captains took more dangerous routes, cut maintenance, carried heavier cargo. The insurer bore the risk. The captain reaped the reward. That's moral hazard in its purest form. Modern insurers combat this through deductibles, car payments, and coverage limits. These aren't punitive. They're designed to keep you skin in the game. When you pay the first $1,000 of a claim yourself, you're suddenly motivated to prevent that claim. The incentives realign. Your behavior shifts back toward caution. But here's where it gets complicated. Insurance exists precisely because people can't always prevent loss. A house fire, a car accident, a diagnosis, these aren't always within your control. So insurers face an impossible balance: protect you without enabling recklessness. It's a tension that's never fully resolved. The economic term is asymmetric information. The insurer can't watch you every moment. They don't know if you're checking your brakes or ignoring warning signs, so they price insurance higher to account for the moral hazard they can't see. That means everyone pays more, even the careful drivers and diligent homeowners. Moral hazard also shapes what insurers will and won't cover. They exclude intentional acts. They require maintenance. They audit claims. All of this is an attempt to filter out the worst incentive problems. It's an arms race between human nature and economic design. Understanding moral hazard rewires how you think about insurance. It's not just protection, it's a negotiation between your incentives and theirs. The deductible you pay, the coverage limit you choose, the exclusions you read, they all exist because insurers learned centuries ago that human behavior changes when risk disappears. And that changed everything. This video is for educational and informational purposes only and is not financial advice. Always do your own research. If you want to understand the hidden mechanics shaping your financial life, subscribe. There's a new system decoded every week. This video is for educational and informational purposes only and is not financial advice. Always do your own research.